Hey guys, welcome to our financial future. This is a channel designed to build a community of investors so we can all achieve our financial freedom. In this video, we are going to go over the characteristics of stock market cycles, what are some things that could cause these cycles, some eye-opening statistics, and at the end, I'm going to give you the only real way to see a recession coming. So let's get into this. Warren Buffett and Peter Lynch don't think you need to be super smart to become a good investor. You just need some fundamental understanding, some common sense, and some emotional strength. Peter Lynch is hands down one of the greatest investors of all time. He averaged a 29% annual return between 1977 and 1990. That's 13 years. He was able to outperform the S&P 500 by more than doubling it. He taught me that in 95 years, the stock market had 50 corrections of 10% or more. This doesn't mean that the whole market was down 10% in an individual year. This means that the stock market could have been up 20% that year and all of a sudden had a 10% correction. What he is getting at is if the market dropped 50 times in 95 years, that's about once in every 2 years that there could be a 10% correction. For example, Christmas of 2018. He also observed out of those 95 years that there were 15 declines of 25% or more. These recessions have been proven time and time again, but they all have been different. They have characteristics like different sizes, speeds, and recovery times. Now that I've got your attention, we have to learn how to spot these cycles. We have to learn how they happen, why they happen, and we also have to learn how to prepare for them when they are coming. This is why having cash in your portfolio is such an important tool. Once we've gained the knowledge about these cycles, we'll be able to turn that cash into something much bigger. We won't know the exact day of these cycles, but we'll see the signs and we'll be ready. When I mentioned the correction in Christmas of 2018, the S&P dropped 9%, the Dow Jones Industrial Average dropped 8.5%. This was the largest drop since 1931. Not even the Grinch himself could have pulled off something like this. One of the key factors of this correction was the trade war between the US and China. The US was imposing taxes on exports of aluminum and steel, and China returned the favor of charging $110 billion on taxes on United States exports. This is something that made tensions in between those two countries grow bigger and bigger and worried the retail investors out there in the market. You might now be able to see how a company that you follow might get caught up in this. Taxes on cars, airplanes, and now cell phones were hitting the bottom line of these companies, making it much harder to be able to produce a profit. This could affect revenue on the top line, and this really drove the market into fear, thinking that these companies were at risk at possible survival. The second event that transpired happened over a period of time, and this was the rise of interest rates. Interest rates rose 4 times that year, driving even more fear into the market. Having higher interest rates for a company means that they have to borrow money at a higher price, making it harder for them to be profitable. Or the company will have to use its cash reserves to fuel production. Higher interest rates in return for a company will make it harder for them to be more profitable. So they will have to raise prices on their services and products, but this in return for the consumer might mean they might not purchase as much, or they will go out and find a different alternative to satisfy their needs. It's a hard decision for a company to choose profitability over customer satisfaction. There really is no right answer. Rising interest rates can directly affect the consumer as well. This can cause them to spend less as it costs more to borrow. This is kind of a double negative for businesses because if the consumer is not willing to borrow money and the business has to raise their prices, it leaves them in a tough position where consumers aren't borrowing that money to spend on more expensive items. There are going to be lots of news events that could possibly affect these companies that you are following. So it is up to you to gather this information and create that future story with these outside factors. Benjamin Graham, Warren Buffett's mentor, has been quoted to say, "The stock market in the short term is a voting machine, And in the long term, it's a weighing machine. And this simply just means that the stock prices can go up because people are buying, but in the long term, the stock market will properly evaluate these companies. So we have to be looking for these signals when we are trying to spot market cycles in the short term and the longer term as the bubble gets bigger. This is very evident in the short term, especially with day trading becoming so popular, because these people can get a hold of a very cheap stock and continuously buy it to drive up the price. Us, as long-term investors, we don't want to let these manipulations in the market affect our decisions, because this could lead us into buying overvalued companies thinking that they are going to go higher because of the fear of missing out. Now that we know about short-term bubbles, let's look at long-term bubbles too. Companies start getting overvalued. People become fearless at buying equities, providing liquidity for the stock market. Private companies start seeing this liquidity going into the market and want to become public. They want a piece of the liquidity going into the market from these fearless investors. We start seeing the median PE ratio of the entire market start going up. We start seeing these companies' PE ratios going higher and higher, and it becomes harder to find value in the market. The long-term investor mindset is the weighing machine part of the equation. This is knowing that the stock market is going to properly evaluate these companies over time and give us the prices that we are looking for. It's our goal just to make sure that we buy these companies at a margin of safety. And sometimes these market cycles can give us an opportunity with these 10% corrections or more in cases like recessions to get those deals. Now for the strategy of the long-term investor to take place during these 25% corrections or more. We're going to want to look for certain things that will help us determine where we are in this market cycle, so we know how to balance our portfolios correctly on weighing them from how risky we want them to how less risky we want them. Some of the most common things about these cycles is the greed and fear. When greed gets going, it's going to fuel this market to keep going, creating a bigger and bigger bubble. When the fear happens, you might hear something called trying to catch a falling knife. Well, that's essentially what's going to happen. You always want to wait till things kind of level out before you really know where you are in the cycle. We will never pick the top or the bottom of these cycles, and we should know by now that timing the market is next to impossible. So it is our goal just to properly balance our portfolios for where we are in a certain time of the cycle. This is where our judgment rests on seeing this greed and fear. Obviously the fear is at the very bottom, and this is when we want to buy. We want to buy stocks when there's blood in the streets. And just like Warren Buffett says, you want to buy when others are fearful and sell when others are greedy. So you want to take advantage of these human emotions that drive the market, and being able to spot them is going to be an important skill that you need to develop. There's three main characteristics, and they're very general and broad, but they are going to be a good guideline to let you know where we are in the market with these human emotions of greed and fear. The first one is the first checkpoint that you want to look for. And the only way we will know this checkpoint we are at is when we are looking back. And this checkpoint is the rise from the bottom. And we'll never know where the bottom was until we are in the future looking back at it. Before we get to the second checkpoint, we're going to see fear starting to subside from the big downturn that we just had. Consumers are going to become more confident and willing to spend more money, and debts are going to get paid off. This is essentially when the dust had settled and we've seen the financial impact with companies going out of business or some still trying to survive. Then this leads us into the second checkpoint, and this is the midpoint of the cycle. Greed nor fear is a dominating emotion yet. The only thing that we know about the midpoint is that we can still see where the bottom was. There might still be some uncertainty about diving into equities, as we just had a very traumatizing time in the stock market. Then there's the last checkpoint, and this is simply just the rise from the midpoint. Individual investors starting to become more greedy, consumers starting to take on more debt, and investing into stocks now, it has become a frenzy. We are seeing more companies borrow money to fuel growth, and more IPOs coming out at a higher valuation than they should be. These are some common signs that we should look for once we start rising from the midpoint. Rising up from the midpoint to the top is a very gray area. We will never know where the top is. This is something we will only be able to see once we're looking back. And that's usually going to be from the bottom. And we can only spot the bottom once we're back at the first checkpoint, which is the rise from the bottom to the midpoint. So you can see how it can be very hard to time these cycles, but there are some very general indicators that we need to know where we are to be able to make decisions as long-term investors. You want to pay attention to how consumers are spending money, how companies are taking on debt, what interest rates are like, what's going on in the macroeconomics. And all of these things are going to affect market cycles and how businesses make money. And this will also show us how consumers spend money to fuel these businesses. So it's us as investors who have to see these cycles and how the consumers and businesses are reacting to the amount of money they can get their hands on and how they are spending it, and who is being greedy trying to make all the money they can. If you like this content, hit the like button. If you're new here, hit the subscribe button so you can get more video updates. I also have a live chat Discord. You can visit that on my website at our-financialfuture.com. There will be more products and services there that you guys can look into and see what is best for you. And I'll see you in the next one.